Hello, everyone, and welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. We're so glad you could join us today. We have with us Scott Varney. Scott speaks for our group a couple times every year, always brings something a little new, and covers a lot of information. So we will be recording this because I'm sure some of you tomorrow will want to go back and listen to some of the points that he made. Scott is a capital gains tax strategist with SB Consultants. He is also a financial services professional. He helps clients think through all of their options to defer, reduce, or eliminate capital gains taxes when they sell highly appreciated assets like your apartment buildings. And he has a background in real estate as a top 1% producer nationally in the realm of residential real estate. And he enjoys being with people, loves the opportunity to help solve challenging issues. And I know he's helped many AAOA members since we've met, Scott, and it's always wonderful to have you share your expertise. Just a couple things. Again, we are recording it. We will send it to you tomorrow. We'll send you Scott's presentation and his contact info and his fantastic resources. He's actually started a whole bunch of new education for his clients, which is just amazing. So we'll send you a link to some of that too. If you like what you hear today and you want to learn more about tax strategy, he has tons and tons of resources on it. With that said, let's stick around at the end for Q&A. I'm going to hand it off to Scott to get started, and he'll take it from here, and we'll come back and do Q&A at the end.
Well, thank you for the great introduction as always, Alexandra. I look forward to doing this um for those of you that are in the SoCal area that are going to attend the conference that AAOA has in October, I will be there. So you will get a chance to meet me in person. And I look forward to that. So if you can be there, come over to the table and I would be glad to meet you personally. So we're going to go ahead and start with the presentation. By the way, when you finish this presentation, that's how you're going to feel. There's going to be a lot of stuff. So I've been a capital gains tax strategist for 7 years. I started as a one-trick pony. And then I learned about a lot more strategies. So now I work with the specialists that are one-trick ponies, and I help the clients to figure out what's the best fit. So I've been doing this for 7 years. My background, as Alexandra said, is in real estate. I closed 500 transactions in 10 years. So I ran like a madman, and I am licensed in financial services. How I operate my business. Well, there's two types of professionals when it comes to sales. There are those that try to make a client fit into their product or solution. Those are the one-trick ponies. Those are the people that are trained to overcome objections. Then there are those that try to find the product that will actually fit the client. And that's how I operate is I look at a person's story. What is it that they have? What are their needs? What are their goals? And let's see if we can find a solution that will get as close to their needs and goals as possible. And by the way, there is no minimum net worth required for someone to set up a free consultation with me. My consultations are free, so that means you will always get your money's worth out of your conversation with me. But I'm not looking for a certain net worth. I had somebody call me from Arkansas one time. The tax bill was $15,000. She was a little bit stressed and panicked because where she was in Arkansas, $15,000 is a whole lot of money. That means the world to them. And so I took the time to help her to think through what her best option was. So don't be thinking in terms of, well, he only works with these kinds of people. I work with everybody, so that is not an issue. Now, while this is general information about various capital gains tax strategies, it does not constitute legal advice. The best way to get guidance on your specific legal issue is to contact an attorney. And if you leave this webinar overwhelmed and confused, you're normal. There's a lot here. Many of these strategies, it's taken me many times going over it to figure it out because they are unique. So there's a lot of info here. The real thing to walk away from this is understanding that you no longer have to be stuck in a 1031 exchange system of thinking. People think, well, either I pay the tax or I do a 1031 exchange. No, there's a lot of options out there, but your CPAs are not telling you about it because they are more often than not, 90+% of the time, they are tax preparers that are good at what they do. They are not tax planners. And so as a result, they're not out there doing all the homework to find out all the legitimate legal tax strategies. They only know of a couple things, and that's what they stick by. And many times the clients I work with, they have actually outgrown their CPA or enrolled agent. Most of the time, the enrolled agents I work with are tax planners. So this is here to let you know there's a lot of options. You're not stuck. Now, in America, there are two tax systems, one for the informed and one for the uninformed. Both are legal. I love that quote from Judge Learned Hand. Now, you may be about to step from the uninformed to the informed. And for many of you, you may already be aware of many of these options. Another quote, the biggest scam in life is paying taxes on the money we make, paying taxes on money we spend, and taxes on things we own that we already pay taxes on with already taxed money. I'm sure many of you are going, yeah, I get that. And now they proposed for us to pay taxes on growth in our investments, even if we haven't cashed it out yet. It's crazy. So the current capital gains tax rates, they're subject to change at any time. They're 0, 15, and 20% brackets, plus the net investment income tax of 3.8%, which is still federal. That's what we call the Obamacare. Now, understand this about capital gains tax rates. They are not progressive. Ordinary income taxes, you'll pay some taxes in each bracket building up. So if you hit the top bracket, all of it is not taxed at the top bracket, is progressive. In capital gains, if you hit the top bracket, all of it is taxed at the top bracket, 20%. So there's proposals. I'll go over that in a moment. The top capital gains bracket that they have proposed is 39.6%. That's an almost 100% increase. And they propose that to be on any gains of over $1 million. Now, here's something for clarification. When they figure out your bracket, they add your capital gains plus your ordinary income in that year to see if you cross the threshold. So right now, the threshold to break into the 20% bracket is $583,750 for a couple. So if people go, well, I only had 400,000 in gains, so I'm in the 15% bracket. Well, if they earn $200,000 of income, so 400,000 plus the 200,000 puts you at 600,000, you've crossed the $583,000 threshold. Now you tax at the top bracket. So you need to understand that. The current proposal, top bracket 39.6. Next bracket up to the million is 28%. So it's a significant increase. The Obamacare of 3.8% is proposed to be raised to 5%. And then, for most states in the country, you have a state tax. California, where we pay a weather tax, we love the weather, so we stay here to pay the taxes. 13.3, I believe they're about to or already approved to raise it to 14.4, and they've proposed to raise it to 16.55. So the top brackets, if you're in California, is going to put you over 60%. That doesn't even include depreciation recapture. And many people don't realize that all of that which you depreciate when you sell off and cash out, you have to pay 25% of that back. And people will go, well, and I talked to somebody 2 days ago on this, I haven't been depreciating. Oh, I've got some really bad news for you. The IRS looks at it and says, well, this is what you should have been depreciating. We're still going to bill you a depreciation recapture tax. So even if you're not depreciating your assets, you're still going to have to pay that tax. So now tax law, per a tax attorney that I am friends with, who actually helped to establish many of the 1031 rules when the IRS met with a few tax attorneys in the 1980s. So if you have a complicated 1031 issue, I've got one of the top attorneys on that because he helped establish the rules. He said that the only law that does not require constitutional due process is tax law. In other words, new tax laws can be made retroactive. So if these proposals I told you about come to fruition in November of this year, they can make it retro to January 1st. So just be aware of that. Now, current proposals with 1031 exchanges. Understand all of this, which I'm talking about, are proposals. They have not been approved yet. People have been watching for decades now. The thought that the IRS was going to get rid of 1031 exchanges. This one is a proposal that helps to go after high net worth in real estate without getting rid of the 1031 exchange. They will cap the amount of capital gains tax deferral in an exchange at $500,000 per spouse per year. So if you're married, you can defer $1 million each year in capital gains with a 1031 exchange. So if you're selling a $4 million industrial building, you paid $2 million for it and you have $2 million in capital gains, you can do a $3 million purchase in an exchange. So your cost basis plus $1 million can be included in the exchange, but the other $1 million you have to pay taxes on unless you set up other strategies. Again, that's just been proposed. Bad timing. So I'm going to tell you right now that some of these strategies I'm going to go over, I personally think it's bad timing. Now, these are the installment sale types of strategies following tax code 453. You have your owner carry, you have your structured installment sales, you have deferred sales trust. So any tax strategy that is spreading out the income to you each year for 2, 4, 5, 20 years, when you're spreading it out, many people do this because what will happen is each year you pay capital gains on that which you receive. So if you spread it out, maybe you go from the 20% bracket down to the 15% bracket. On rare occasion, we actually get somebody to the 0% bracket, but we have to work closely with their CPA on this. So people think, well, I'm going to reduce my taxes. I'm going to spread it out 20 to 15%. Well, if you do one of these strategies now and they approve to increase it, you might not go from the 20 to 15. You might go from 20 to 22, 23, 28% by spreading it out because they have the new tax brackets. So you might end up paying more in taxes. So how you invest the funds within that strategy might make a huge difference on whether or not you're going to be paying more taxes or not, in terms of the value for a long-term strategy. This needs to be coordinated with your tax professional and then somebody like me, that will look at your case and tell you this is a risk. Now, everything is fact determinative when it comes to tax strategies. The legitimacy of a legal tax strategy often comes down to how it's set up, how it's managed, how it's reported. One case can be allowed by the IRS and another case can be disallowed based on the facts of, again, how it's set up, managed, and reported. So 1031 exchanges can be disallowed if not done properly. There's not a lot of case law out there for capital gains strategies, so you have to make sure it's done well. And you work with the attorneys and the tax professionals on making sure it's set up appropriately. Now, the agenda, we're finally getting to the agenda. The agenda for today, we're going to do it based on timing. Those that need to be set up before closing, those that can be done within a 1031 exchange's 45-day ID period, rescuing a failing exchange, and then those that can be done after closing, but there's no exchange involved. And then if you have a QR code reader, I have a couple of things that you can use a QR code reader for at the end. So these are the strategies that have to be set up before closing. First is your traditional installment sale. That's the owner carry. That's where the seller becomes, in a sense, the lender for the buyer for a specific period of time. So let's say you do an owner carry over 10 years. So you get 10% per year. So that 10%, that's what you pay the capital gains on. And then, of course, you're going to charge interest. And so you're going to have to pay ordinary income taxes on the interest part and the capital gains taxes on the gains part. But that's for only that 10% that you're collecting each year and spreading it out. Remember, this could be a bad timing issue. When the note gets paid off, let's say you do a balloon payment, you do 12.5% for 4 years and then 50% in year 5. There are some strategies that may be available to defer the capital gains on that balloon portion. So we have to look at that year by year. So again, a lot of times people will do this strategy because they want to lower the tax bracket. And that could be an issue. Structured installment sale. This is done in such a way where you do not have constructive receipt. When you close a property and funds go into your account, you have constructive receipt. Taxes become due the next year. In a structured installment sale, the funds go to a holding company, an attorney group, asset dealer, so you don't touch the funds. And then they do different types of investing, and then you're going to get paid based on the contract. In some cases, an annuity is used. So the funds will go to a holding company. The holding company buys the annuity based on the guidance of the client that says, I want annuity payments for the next 10 years. So the annuity pays out. That's, for many people, they feel a lot safer doing it that way than they do an owner carry to an individual, because the individual may default. Now, I've met people that want the individual to default because they get a big down payment again on the same property. That's how they make a lot of money on the same property. It's pretty sad thing what happens, but they make a lot of money doing that. But the annuity is guaranteed by an insurance company. So those payments are going to come. And I did a deal with a client in Florida. We got him to the 0% bracket by doing this annuity. Now, if the gains exceed $5 million per person, if you spread out or defer capital gains using tax code 453, the government, the IRS, wants you to pay interest on any tax deferral on anything over $5 million of tax deferral. And that's where many times people will work with attorneys to set up series LLCs to help to work through that issue so that you're not paying that interest. And if you're doing this with an annuity, let's say it's $1 million sale, $300,000 of debt, you're going to have to pay the mortgage boot taxes. So you're going to have to pay some taxes because the annuity does not replace that debt. So you'll put maybe $600,000 into the annuity and spread out those capital gains and pay a proportionate amount on the debt. But again, bad timing. Anything spreading it out, unless you can get to the 0% bracket, which we cannot guarantee moving forward, they will continue to have a 0% bracket, but we hope so. Deferred sales trust. This is another 453 strategy. I started with all the 453 strategies. This can be used for real estate. It defers and it's also known as a DST, but there's multiple DSTs. Proceeds from the sale will go to a third party, so you don't touch them. And that can be invested in real estate, investment products, or a business, and you pay proportionate taxes annually. Most people that set up these DSTs that I talk to, when I've talked to professionals, they don't start those payments for 7 to 10 years so that there can be some momentum on the growth in the investment. Here's an issue. This is why none of my clients have actually done one of these, even though I'm connected to advisors that do them, set these up. No control. This is controlled by a third-party trustee. So what happens is the funds go to this deferred sales trust. That trustee manages the investments. You are considered a creditor of the trust. As a creditor of the trust, you are not allowed to dictate where the funds are to be invested. You can say, hey, I like this stock or I like this stock, but they can choose to ignore you if they want to because you're only a creditor. So you have no control. And my clients typically don't like the idea of no control. There is a time to use this strategy, but in this case, you have to be aware of that. Now, the cost up front's 1.5% of the first million, and typically 1.25% of everything over the million. Then it's going to cost 1 to 1.5% annually. If you invest in real estate with the funds in the DST, you can actually start a new depreciation schedule, which can be super helpful. The various DST specialists I talk to say that it makes most sense when the capital gains at least $1 million. And you can defer the taxes for 10 plus years. You don't have to start those installment payments for 7 to 10 years. Now, this strategy can be used to defer capital gains taxes on a future balloon payment. So remember, 4 years at 12.5%, at 50% balloon payment, if it meets the minimum requirements. And again, we had that $5 million per person issue with interest. In California, if you're using this strategy to rescue a failing exchange, California will require the qualified intermediary or the trust or the title company to withhold 3.3% of the sale because they do not honor this. And then you have to fight to get your money back when you file your taxes. Woohoo, lots of fun. Now, LLC with charitable intent. I have a meeting today with a business owner sale. This can be a great strategy for sales of businesses and real estate. This can accomplish great tax mitigation and create a significant charitable deduction at the same time. Typically, they're looking at a 1.3 minimum, $1.3 million sale minimum for real estate or business for it to make sense because of the cost. You donate your asset to an LLC that is set up with charitable intent. So if it's $1.3 million that's going to, when you donate the asset to the LLC, that 1.3 million will eventually go to charity within 90 years, but you can still cash out on that. So it goes to the LLC. LLC loans you the funds to buy a high-end permanent life insurance policy. So the cash goes in there. This death benefit exceeds what you have to pay back for that loan from the LLC. Then a third-party lender loans you the cash against the death benefit as collateral so that you actually have your cash to go do what you want to. When you pass away, the death benefit pays back the loan from the LLC that set up that life insurance and pays back the lender. And then if there's anything left, that goes to your beneficiaries. So this is a way that the charity is going to get 100%, but you're only going to pay tax on 1%, the way this is structured. So you're going to pay 1% of the capital gains, and you're going to still get your money. So charity gets all that money, and then you're also going to get your money to utilize. This is complicated. Now, the cost to set these up, and this has to be done in advance, ranges from $40,000 to $110,000 plus. That's why $1.3 million makes more sense because of the cost. And the reason for the range is if you hire attorneys that actually give you a tax attorney opinion letter, that's going to be a lot more significant in terms of cost. This can be used in some cases to mitigate capital gains taxes on a balloon payment later, depending on the structure and nature of the sale. So, and also this can be a transactional strategy. So you can utilize this for multiple sales. So it's not just one transaction. So there's a little bit of flexibility in there, but it's complicated. And I have a team I work with to set these up. I will let you know if it makes sense. For those that sell businesses, if it's an S Corp sell, which, by the way, I'm going to give you a little insight here. S corporations are a wonderful tool when you're running a business. When you go to sell, it limits your tax strategies. It's great when it's active, but when you go to sell, it brings limitations. And for example, this strategy can be used for an asset sale, but it can't be used. You bring me businesses for sale, a lot of the options available. So be aware of that. And when you know you're going to sell, then you may want to revert back to either the LLC or a C Corp with that. And by the way, if you own real estate, do not buy real estate and put it into an S Corp, because if you decide to close the S Corp and you put that in your name, that is considered a distribution at actual market value. So that creates a taxable event. All right, complex spendthrift trust. This can defer capital gains taxes for generations, passive income taxes, that's rental income, stocks, bonds, mutual funds, cryptocurrency for generations, active income taxes for those that have self-employed income. Actually, I have 2 trusts so that I defer much of my income taxes for my business. So you could defer 50 to 90% depending on how, or up to 50 to 90% depending on how you have things structured. For last year, about 60% of my taxes got tax deferred. We work with clients to get up there to about the 90% range. This also provides ironclad asset protection. So what you do is you don't gift or grant your assets to a trust. You sell your assets to the trust. The trust owns the assets and has much more solid asset protection than your LLCs. LLCs are pierced 40% in state and federal courts. A lot of people don't know that. And I have a presentation next week on this type of trust. Now, because the trust owns the assets, if you pass away, or when you pass away, if your value of your assets exceeds the estate tax exemption, because the assets were owned by the trust while you're alive and then after you pass away, there is no estate tax. This is a great way to pass on generational wealth without the 40 and now proposed 45% is federal estate tax plus state estate taxes. These trusts cost $20,000 to $40,000 or more to set up. So it has to be done in advance because, like everything else I showed, it has to be in place. So the trust has to sell the asset to get the tax mitigation. The asset needs to be in the trust when it's sold. There's no seasoning required. What that means is you could call me if you have a contract on a trust. If we have enough time before closing, we can get the trust set up, transfer the title to the trust, and the trust is the closer or is the seller, and maybe a simultaneous close. We can do this quickly, week to 2 weeks out of closing. So there's no seasoning required based on the tax professionals I've talked to. Charitable trusts have to be set up in advance, again, because it has to be the trust that sells the asset. In this case, you are donating, you're not selling, you're not granting, you're donating the asset to the trust. And this can eliminate capital gains taxes. So you get a significant tax deduction for that donation. And then the trust sells and gets the tax mitigation. Investment properties can be a part of this charitable trust. Now, one thing about charitable trusts is that they require an appraisal. So when you donate the asset, a third-party appraiser has to do an appraisal. You have to back it up with that appraisal when you do the tax filing. And that's because the IRS has seen where we tend to overvalue items that we donate. So they want a legitimate value. Um, so that will be done. In some cases, you might have to have an appraisal done each year. Now, from an expense perspective, this is where we have to look at the numbers. If you donate a $1 million asset to the charity, you get a tax deduction. Now, 10% of that $1 million has to go to charity. So $100,000. Many times that gets too close to the actual tax bill and it doesn't make sense. And the reason is by the time you pay that 10% to charity and you have to pay for the attorney's fees, the numbers don't sync up well. Now, if you sell the asset and then you donate immediately, that's what's called a charitable deed trust. If you sell the asset, wait for distributions, and then the last 10% left in the trust goes to charity, that's a charitable remainder trust. Now, there are distributions. This is why even if you get to save a little bit of money, it may not make sense. Your distributions range from 2 to 20 years, 5 to 50%. The longer the distributions, the higher tax deduction you get. The shorter the distributions, the lower tax deduction you get. You have to work this out with your attorney and your tax professional. So with the cost and the limitations of distributions, that's where you get into the issue. But many people do this with their stocks and real estate. Because if you have a significant gain, it could definitely work for you. Now, upon the sale of the asset, monies can be invested. So you sell the asset, you have to wait for distributions. You can invest those funds so that it's growing in a tax advantage way. But one big limitation is most attorneys I've talked to want the asset to be free and clear of debt when it goes into the trust. I've talked to an attorney that said as long as the debt has seasoned for at least 5 years, they can make that work, but they mostly want free and clear of debt. So that could be a huge limitation. 1031 exchanges. Most of you may already be aware of 1031 exchanges. I closed 500 transactions in 10 years. I did one exchange, and when I was done with the exchange and that property was closed, I still don't know what I was doing. So, but I was teamed up with a business partner for 6 years that has done exchanges for 30 years, so I learned a lot. So now we do other transactions together, but we're just not business partners. You can defer capital gains taxes for as long as you own real estate. You continue to exchange and exchange and exchange. And then when you pass away, your beneficiaries get a step up in basis, so that could eliminate capital gains taxes. What is that? If you pay $200,000 for a property and you sell it for $1 million, you have an $800,000 gain that you have to pay taxes on. However, you bought it for $2 million or $200,000. It's worth $1 million when you pass away. Your beneficiaries get a step up in that cost basis. That $200,000 now becomes $1 million. So if they sell immediately, there's little to no taxes. That's what they call the swap until you drop strategy. Now, step up in basis has been proposed to be eliminated. So that's not a guarantee. That complex trust doesn't have to deal with that. But here, if you do this, your beneficiaries may still get taxed if they eliminate that. Now, this is really huge because I've had many people call me saying, I closed a property last week. The title company has the money, so I haven't touched the money. And I want to do a 1031 exchange. And I have to be the bearer of bad news. I have to say, I am so sorry, but the title company is nervous right now holding your money. You already have constructive receipt. And they're like, but I haven't touched the funds. And I have to say, your contract for a 1031 exchange has to be established in advance of the closing so that the funds can move from the title company, or if on the East Coast, the closing attorney, can move the funds to the 1031 intermediary or accommodator, depending on what you call them. So that's usually a shocker for them because they thought as long as they just don't touch the money, they're okay. Nope. Contract has to be established before closing. You have to replace like-kind property of equal or greater value to get full tax deferral. But like-kind is broadly defined. You don't sell a single-family residence and have to buy a single-family residence. You can sell an SFR and move into multifamily rentals like apartment complexes or retail space or Delaware statutory trust. Anything that has leases with 30 years remaining, that's like in Hawaii, where the state still owns the land, but you own the structure. So it has to be, a lease has to be at least 30 years. So you have flexibility within this group of assets. What is not a like-kind property is a primary residence. That's that 121 exclusion of $250,000 per spouse, which, by the way, a lot of people don't know this. If you lease a part of your primary residence, Airbnb, Vrbo, or you just have long-term tenants, but you live there and you're leasing a portion of it, or you have an ADU that you're leasing out, you can claim the 121 exclusion and cash out on the $250,000 or $500,000 and exchange the balance of it. So there's ways you work with a tax attorney like my guy to get it exactly down to the numbers as to what you can do. You can get both the exclusion and a 1031 exchange. Fun stuff. Second homes may or may not qualify. You have to talk to your tax professional on that. Here's the thing about tax professionals. If you ask 5 of them the same question, you get 7 answers. Why is that? Because if you ask 5 IRS audit agents, you get at least 5 answers. The IRS doesn't even agree with itself within itself. So CPAs, enrolled agents don't always agree either. You have to have reasonable defense of what you do. Real estate flips do not work. That complex trust does work. Developments does not work. That complex trust does work for an ongoing tax deferral opportunity. Real estate investment trusts, known as REITs, typically are a membership interest in a trust and not exchangeable, because for it to be exchangeable, it has to be a property with a legal address. A mutual ownership trust like a REIT, where you have lots of investments, does not work. So unless the REIT is considered real property and not a partnership interest in that REIT, then it's exchangeable. But typically they're not. There are what's called 721 exchanges, where you can do exchanges. Actually, I'm going to add that to the next presentation. But typically they're not exchangeable. You have to replace debt with equal or greater debt. Boy, this is a shocker. If you got $1 million sale, $300,000 in debt, many times people think, well, I'm just going to exchange the cash portion of it, pay off that debt, exchange the cash. They don't realize you have to replace the existing debt of the relinquished property with new debt, unless you pay out of pocket cash to replace that $300,000. So if you had $300,000 of debt over here, you have to have $300,000 over here. Otherwise, you have what's called mortgage boot, and the government's going to tax you. Many people don't realize that. Other rules, you have 45 days to identify and 108 days to close. And here's a huge insight that most accommodators don't tell you. And if you're a realtor, this is good for you and your clients to know. If you do not identify a property, the accommodator is allowed to release the funds on the 46th day. That's the rules. If you do identify a property, they're not supposed to release those funds until the 181st day. Not because the accommodator wants to invest your money, make money off your money. That's the rules. So if an accommodator is releasing funds earlier, you better make sure there's tax people involved in that decision to do that. That will protect you. Now, if you have a client looking at properties, don't identify a property until you have one under contract. Still has to be in 45 days, but wait till you've negotiated a contract, then identify that property. That way there's a greater chance that you're going to have one to close, because Again, if they don't find something that they like and decide I quit, they will want those funds on the 46th day. So they can do something with them 135 days earlier. So a little insight. Now, private family foundations like a public charity or public foundation is dedicated to carrying out a charitable mission. This is only really valuable for those that really have a charitable mission and they want to actually spend time involved with charity. You'll see this with professional athletes that have foundations for tax mitigation, but they get out there, they do camps, they do a lot of things in the community as part of their foundation, charitable, intent. It's funded and controlled by an individual, family, or corporation when it's the public, but here, private foundations are funded personally by sales of real estate, sales of businesses, or just a lot of cash that you have. So these foundations can address income taxes, capital gains taxes, and estate taxes. But the key is to have legitimate charitable intent. You'll need to contribute to the foundation on an annual basis. Therefore, it doesn't make sense to be a transactional strategy. This can eliminate capital gains taxes, but there will be a nominal excise tax of 1.39%. And the tax deduction for donating your asset to the foundation could count against 20 to 30% of your adjusted gross income. Business sales. So if you have a business sale and it's a C Corp, talk to a tax attorney. If your C Corp stock qualifies as small business stock, qualified small business stock, then tax code 1202 will give you an exemption. So the first 10 million will be excluded from capital gains or 10 times the adjusted basis of that stock being sold. But you have to talk to a tax attorney to make sure that your stock qualifies for this tax treatment. Now, what about within the 1031 exchange? We're looking for mailbox money. You want to get rid of the tenants, the trash, the toilets. You want to ride off into the sunset, but you don't want to get out of real estate because of the value of real estate. And you want to stay in real estate because of the tax deferral and step up in basis for your beneficiaries. Well, Delaware Statutory Trust is a securities regulated investment. These are very settled in terms of tax solutions because there is an IRS ruling back in 2004. That's hard to get, but there is a ruling. You own beneficial interest in real estate and not the real estate itself, so you are going to have a proportionate ownership in the real estate. It could be a 20 or 50, 100 million, 200, $500 million property. And so it's a significant property with up to 2,000 investors. This generates mailbox money, so you're just going to get checks. And they will provide depreciation schedules. And then they sell every 5 to 9 years. A lot of people will say 6 to 8. I'm finding 5 to 9. And you can exchange into another DST if you would like, with all or a portion of it, cash out some of it. So the goal and hope is that you have some appreciation available when it sells off then too. So it's truly passive income. You don't manage the property. They have all of that in place. These will range in cost from 8 to 15%, but that's reflected in the income. I'm doing a presentation on this next week that I'm hosting. You can exchange into and out of a DST. If you exchange into a DST and wait a couple of years, you could do a 721 exchange from the DST, one property into a portfolio of properties in a REIT. So there's ways to use a 721 exchange from a DST. Limitations, you have to be an accredited investor. Purchase is not typically liquid, but we can talk on that, and is trustee controlled. The accredited investor requirements are your adjusted gross income has to be 200,000 as a single person or 300,000 as a married person or married couple. So it's either one of these, or you have $1 million in investments, not including your primary residence. So if you have $1 million investment property and you have 300,000 in debt, that 700,000 of equity counts towards that $1 million. There is an optional cash out DST where you can exchange into a DST and you can actually cash out 30 to 90 days later up to 85% of your equity to do other things with. So that could be really helpful depending on the needs. But it really is a situation where we have to walk through if that makes sense. But there is a way to cash out with a DST. Tenant in common. These are securities regulated. You have co-ownership with investors with proportionate ownership. It could be 10 owners at 10% or 10 owners with varying percentages, 5, 17, 22. It doesn't have to be equal. You can exchange into and out of a tenant in common property. You have direct ownership in real estate, and it is passive income. Management terms are put into place, so you have true mailbox money. Limitation, you have unanimity of all owners in decision-making process. If we're married, you ever run into issues trying to agree on a decision? That's with 2. You add a 3rd, a 4th, a 5th, a 10th partner, it becomes difficult to agree. So I know of a situation where they were selling a tenant in common property and everybody agreed with the price except for one person. That one person was not willing to sign off on the contract unless they made a certain amount of money from the proceeds. Everybody else had to give up $200,000 a piece to satisfy that one person. That's a lot of control that one person can have. So unanimity can be an issue. There's a lack of lending for TICs with more than 10 to 12 investors, but there is a liquid 1031 exchange using a tenant in common property. Minimum is typically about $600,000, where you can cash out, 90%, 93% of your equity in that property within 30 to 90 days. So there's a way to do an exchange and get a cash out to take care of other things. Fun stuff. Rescue a failing exchange. So your exchange hasn't failed yet, but it's going to fail. It's a failing exchange. There is a legal review on transitioning funds from Tax Code 1031 to Tax Code 453. This is where, those bad timing types of strategies might make sense, is in rescuing a failing exchange. But you have to hire an exchange accommodator that will cooperate with a rescue. Most accommodators do not rescue failing exchanges. So that structured installment sale, there may be one that will rescue a failing exchange, typically not with the annuity strategy, but other types of strategies within that option. Deferred sales trust can rescue a failing exchange. That's when I think it could be valuable. But the key is that you have to work with an accommodator that will allow you to do a rescue. So this is where we tell people that if you really want to complete that exchange, you do a Delaware statutory trust as a backup option or third option. See, great companies like IPX, they're awesome at what they do exchanges, but they will say, hey, complete the exchange or pay the taxes. Oh, you're having problems? We'll do a Delaware statutory trust, to complete that exchange. So you need to find an accommodator that will work with you on a rescue if you think that may be necessary. Now, what if you've closed a property and you did not do an exchange? Well, you have qualified opportunity zones. We're getting close to the end here. So hopefully I didn't put you to sleep yet, at least yet. Qualified opportunity zones, gains from the sale of stocks, bonds, real estate, interest in partnerships can go to opportunity zones. You can invest the gains only and retain the basis. So if you have 200,000 cost basis and 300,000 in gains, you can invest just that $300,000 in gains and then cash out on the basis. That's really helpful. This defers taxes through December of 2026 to be paid in 2027. They're discussing things in Washington now to do extension so that new investors can extend it later. This can reduce or eliminate capital gains on future gains. Now, one thing that needs to be made clear is if you have a $300,000 capital gain today, those taxes are due in 2027. They're not eliminated. They are due in 2027. Now, if you invest 300,000 today and it grows to 700,000 over the next 10 years, if you keep it in there 10 years, at a minimum of 10 years, then those gains are federally tax-free. That 400,000 of growth is federally tax-free. State to state will defer. California does not recognize this, so you still have to pay the California taxes. So today's gains are deferred until 2027. Any future gains, if you keep it in there for 10 years, federally tax-free. So they need to be invested in the Opportunity Zone Fund within 180 days after closing. If it's an actual LLC that sold the asset, the tax professionals may allow you to have an extension beyond that. Those funds will be put into a ground up development or substantially improved properties. Ground up means that your benefits are going to be long-term, substantially improved, may result in rental income sooner. So you have to be an accredited investor, and they do have companies that certify that accreditation. This has to be done separate from a 1031 exchange. Many tax professionals will not allow you to move from a 1031 exchange to an opportunity zone. In some cases, again, this comes down to your tax attorneys, what they will allow you to do. You can invest long-term and short-term capital gains. Limitation of benefit, again, your state may not cooperate. California does not cooperate. If you go to the IRS.gov site and look up the Opportunity Zone FAQs, you're going to learn a lot from that alone. Charitable gift annuity, this can be set up ahead of closing so that the charitable organization sells the real estate and gets tax mitigation. But the problem is that you don't get as much tax mitigation. The donation of the asset can only count against 30% of your adjusted gross income. If you sell the asset and you have cash and you put it into a charitable gift annuity, basically you donate it to charity, you're going to get a tax deduction, but because it's cash, it counts against 60% of your adjusted gross income as cash versus 30% as an asset. So part of the donation is going to be considered, an actual donation. Part of it's going to be an investment. They buy an annuity that generates an income stream for you. And it's best if that annuity, you get more of a deduction if those funds don't start paying out for at least 5 years. 3 years could be okay, 5 years, and then the income starts. Charitable remainder trust can be done because you're doing a cash donation, could get you some tax benefit as well. Federal tax credits. These can be used against ordinary income and capital gains. The leverage opportunity of tax credits, sometimes there's not enough of a leverage to warrant the value for capital gains. Because if it's like a 90 cents on the dollar type of leverage where you get to save 10%, maybe capital gains won't work. Next week, I have a presentation on one that is 60 cents on the dollar. So $60,000 gives you a $100,000 tax credit. Not tax deduction, but a tax credit. And so that saves you $40,000. So there's, this can also be valuable, by the way, for those of you who like to leverage debt. When you're doing deductions, that impacts your income. So now you can't qualify for as much. If you do tax credits, that's a credit for the taxes. So it's not a deduction. You still have a high income. So this is where we get into all kinds of fun stuff. And for those of you that have not filed your taxes yet, if you had at least $80,000 in federal taxes that you're going to owe, we have tax credits available. Presentation next week. All right, cost segregation. This is a form of accelerated depreciation. Many people use this to reduce their income taxes from their properties. And you know what that can do is, because you combine income plus gains to determine the bracket, if you sell an asset, that could reduce your income and help to possibly reduce your capital gains taxes. So this is applied to your structure only and not the land. You have subcomponents of assets of real estate, your fences, your roofs, a lot of things that do not last 27 and a half or 39 years. They have a way to accelerate the depreciation on those types of assets. If you do this, you want to keep those assets for 2 to 3 years. So you are accelerating depreciation to reduce your income from your real estate. There's a non-tax tax strategy, I like to call it. In some cases, if you sold your asset, if you want to ease the gut punch, if you got some resources from that sale, put some of it into an annuity that has a good signing bonus. I'm working with a client right now out of Nevada, sold a business here. And right now there's an annuity with a 45% signing bonus in one day that counts towards future lifetime income. So you don't cash that out, but it does create income during your go-go, slow-go, and no-go years of your retirement. So that's a way that you look at your estate value, because you get a 45% boost on that part. Then after you pay the taxes, it doesn't look like as much of a hit on paper. So that could be helpful. So numbers, goals, personality. I always have to look at the numbers. Some of these strategies get too close to the tax bill itself. It doesn't make sense. And then the goals. Oh, also with the numbers, there's long-term commitments. Are you having to pay tax professionals for the rest of your life? Whatever it is, we've got to look at all that. The goals. What do you want to do? If you want to sell a real estate property, investment property to pay off your primary residence debt, well, that really limits your options. But we need to know what it is you're trying to accomplish so that we can find the strategy that is the closest fit to meeting those goals. And then there's personality. Some people would rather just pay the tax, no matter how high it is, and just be free and clear of long-term commitments, restrictions, tax reporting. That's who they are as a person. Others will take and use every opportunity they can to leverage tax strategies to build wealth by deferring taxes and growing their money. But many of those, not all of them, but many of those in that personality will look at the first person and say, you're an idiot for paying those taxes. Well, no, it's not a maturity issue. It's a personality thing. And I like to know that person. So we have good conversation. That's why it's valuable to have a free consultation, because I will get to know you and you're not on the clock while I'm getting to know you, because I want to make sure something is a good fit overall for you. So this doesn't apply here. If you are part of a real estate agency and you want me to do a presentation for your team or your clients, let me know. And I know Alexandra will have a poll for you guys. I will be glad to do a webinar for you. And then also, if you have QR code reader, there's a calendar link right there. You can set up time immediately. Alexandra is going to get that information out to you. I also have an education platform where I have 103 episodes right now. By the end of next year, we plan to have at least 500 that has living trust episodes right now. Lots of different capital gain strategy episodes, reverse mortgage episodes, business sales stuff. So this is a great platform to learn from. And for those of you in real estate, if you have a client that's stuck, not knowing what to do because they're afraid of that tax bill, you can gift them a month so that they can watch a lot of episodes on tax strategies. And for those of you that haven't filed your taxes that need a tax credit right away, there is a tax credit deal right there. So let me escape this here real quick. Um, Time for questions.
All right. Can you hear me okay?
I
All
do.
right, great. Well, that
Hey,
was a
we got it. We got
fantastic
it to the hour.
presentation. Yes, we did. Good timing there. So again, everyone, we will be sending you the recording if you have to head out, but I hope that you can stick around because we do have some good questions as well. Um, Heidi asking, can a DST be established among relatives?
So, um, if you're so deferred sell or Delaware statutory trusts are securities regulated investments. So if you're talking about establishing it to where you have properties investors, you go. I mean, there's only like I think 50 different sponsors out there or something like that. This is very, very critical. But you can invest into DSTs with family members. So if you want to create an LLC and invest into that, you can do that. I would recommend that you go into it individually because if you decide to exchange out of a DST later, if you have the same tax ID number together, that exchange has to be done together.
Hmm,
Can't go separate ways.
got it. Okay. So a couple other questions from Heidi. A property that has been a rental for 9 years and then vacant for the past 5 years, but periodically has been on the market for the rent to be a rental, but didn't actually rent. Is that still qualified for a 1031 exchange?
Absolutely. And and that's where you could set up time with me. We'll talk through options there. But yes, that still qualifies for a 1031 exchange.
Wonderful. And she also asked if you could provide any contact information of any CPAs or tax attorneys for 1031, DST, or complex trust. So I'm guessing the best way to do that might be to just reach out to you.
The best thing to
Okay.
do there is actually take some time with me.
Hmm.
Let me get to know your situation to see who's going to be a good fit
Yeah,
for
that
you
makes
as a
sense.
client. So because I have tax professionals around the country I work with, but it's a matter of making sure that they're a right fit.
I agree. And so those of you that said yes to that poll question or you scanned the QR code, we'll expedite that and make sure that Scott gets that list of you all who said that you want to set that up. Lisa is asking if loss carry forwards were used up on 2023 taxes, can any of these other options be applied retroactive to 2023 tax year to save the loss carry forwards?
Yes, the only one that I know of is that tax credit. If the taxes have not been filed yet,
Hmm.
then I have a presentation next week on the tax credits that can be applied to last year. Um, so an email will go out. Um, anyway,
Okay.
as a matter of fact, um, here's what I can do
Yeah.
is the chat box. Those are all my presentations next week.
Amazing. Okay.
I've got four of them. I'm a
Good.
busy guy next week.
Oh my goodness, Scott. Yeah, you're always speaking on this topic. I love it. Lisa says she already filed, unfortunately, but I know some of you can probably still take advantage of that, and it's probably good to know anyway. Even if you already did. David has a few questions. I'll start with this one. The qualified opportunity zone. Can you buy and um, your invest on your own with your gains?
So if you are not going through an opportunity zone fund manager that already has these in place,
Hmm.
you can do, you can work with 1031 exchanges, but you have to go with a tax attorney that knows what they're doing with those individually. Otherwise, you go into it with an already in place fund manager that has projects, but you don't exchange into this. But you can set it up. Um, so if you want to do it yourself, you're welcome to do it yourself, but you have to work closely with a tax attorney that knows what they're doing.
Mm. Good advice. David is also asking if a property is purchased in a life estate and was set up to buy until the seller passes or leaves the home, The investor helps the owner maintain the home and expenses in the meantime. How is this taxed and can you get depreciation?
Um, Possibly, but that's where you talk to your tax professional specifically. Again, remember five tax professionals, seven different um, uh, answers. You have to talk to the estate attorney that has this set up because many times they know exactly how it's set up and what the taxable consequences are, and then you work that out with your um, tax professional. My job
Yeah.
is to when a lot of times I end up sending people back to their tax professional to figure out what their tax bill is or what is taxable, and then I provide the solutions with those answers because when you get into these trusts and whatnot, I can't give a blanket answer. And sometimes they're actually going to go over my head and you got to go back to the attorney that drew it up, knowing exactly what the benefit was.
Yeah, it gets pretty complicated sometimes depending on the situation. So, got to have a whole team here really working on some of these. So David had another sort of example. He wants to know the process if you have a property. So, for example, if you have a $1 million property to give as down to buy a $4 million property, and so you end up with a $3 million income property balance to finance, or some seller finance, what's the best strategy to not fall out of the exchange if they're doing a 1031?
So you want to go from a 1 million to a 4 million.
Hmm.
That actually is doable in an exchange naturally.
Yeah.
Yeah, as long as it's equal or greater. And here's the value of this. If you go from 1 million to 4 million, that increase is actually an increase in depreciation schedule.
Hmm.
So that could be very valuable that way. But that would be a normal exchange. You identify the property, the $4 million property, and they do this. Actually, this is fun. For those of you that have free and clear properties that you want to write off into the sunset, but you want to build wealth for your estate, you do what's called a lever up in a DST, a Delaware Statutory Trust. You exchange into Delaware Statutory Trust so you don't have any management stuff. So if you got $1 million going into that, but you find a DST that has a 50% debt service, so now you basically assume that 50% without applying for it. Now your million becomes 2 million. So your net worth, the appreciation is based on 2 million and debt is being paid down while it's in the DST. So you have a greater equity position for
Mm.
your estate in the future. Oh, this is how people get even more wealthy.
Yeah, that's a great way to retire, certainly. Okay, well, I think that wraps up questions pretty much here. And, as I mentioned before, I'll say it again. I'm going to send you all the recording tomorrow with Scott's information, his education platform. Scott, you put that link in there to your webinars this week. I'll put that in there too for the rest of the people here. Um, we have another question from Heidi. Well, maybe we could answer this before we
Okay.
let you go. In California, it is a fast market. There is a possibility that the properties that are identified within 45 days will sell and may not be available by the time the rental property is sold. What are my options? You see that happen?
Mm-hmm. That is a problem.
Mm-hmm.
And so you could, if you believe that you're going to get the sale, go ahead and get the property under contract and extend the closing date based on the property that you want to sell and exchange into that. And then once you close on the property you're selling, identify the one you already put under contract.
Okay. Yeah. So that's gonna basically you have to try to get the property first so that it's more certain.
But
And
if your property
yeah.
doesn't sell, now you're stuck with that purchase. Yes,
Yeah.
you could do what's called a reverse 1031 exchange where you buy it and you actually do everything in reverse. That requires a tax attorney like my friend Walton out of Hawaii to do that. But yeah, you can buy the property and then actually um, as long as you sell the other property and get it closed within 180 days,
Mhm.
that can
And
work.
there's some more cost to that, right? Because they have to hold the money longer, the qualified intermediary. So I think it is a little more expensive, but it's more certain. So I
Yep.
guess whatever you feel comfortable with, I guess if you know the market is selling pretty quickly, that might be a good option to do that instead. Yeah, the time
Uh,
frame is tough to work with a lot. Yeah, that's what I've noticed.
It is, and they've actually proposed to eliminate the 45 days and just
Mm,
make it that you complete the exchange in
interesting.
180 days. That would be super helpful. The complex trust, you'd never have to do an exchange again. You can sell and buy whenever.
Well, that's even better. I mean,
Yeah, even better. So, but reach out to me and I will get you the attorney's information that you can do a consultation with on the reverse exchange. He's an expert at that.
okay. All right. Well, we'll close it out here. Those of you still on the call, please take the exit survey. Let us know how we did, and let me know if you want tickets to the rental housing conference. Scott is going to be there. So will I. We will meet you in person. Really excited for it. It's October 16th in Long Beach, California. We're going to have lunch, we'll have games, we'll have presentations. You're going to learn, meet a lot of new people, and it's a whole day. So, if you can make it for just part of the day, that's fine too. AAOA members do get free tickets, so they will go fast. We have very limited capacity right now, and we already have about, quite a few people already pre-registered actually. So please say yes to that if you want to come so that I can make sure I save you a spot. And I'll send you the recording tomorrow. And thank you, Scott, again. We really appreciate having you on as usual.
Oh yeah, I enjoyed it as usual.
All right. Take care, everyone. Bye.
Bye.